All right, let's get into it. Today we are diving into a really powerful and, let's be honest, kind of wild financial idea. The concept of becoming your own bank. The goal? To turn your brokerage account into a machine that just constantly generates wealth. But the most aggressive version of this strategy is like a high-wire act with no safety net. So here's what we're going to do. We're going to break down that original high-risk plan, see exactly where it goes wrong, and then build a much safer, smarter version. A blueprint you can actually start in just 1 week.
Okay, so here's the game plan. We'll kick things off with the big, exciting theory. Then we'll get real about the dangers, what I'm calling the leverage death spiral. After that, we'll face a really important philosophical choice, which will lead us to the sustainable wealth blueprints, and we'll wrap it all up with a concrete, step-by-step launch plan. Let's do this.
So what in the world is this be your own bank idea anyway? Well, the short version is, it's a strategy to keep every single dollar you have fully invested, working for you 100% of the time. So instead of, selling stocks or using cash from your paycheck to pay your mortgage or buy groceries, you use your investment portfolio as collateral, and you borrow for all of your living expenses. This frees you up to invest every last bit of your income.
And the logic here is, it's pretty straightforward. You want to earn more than you owe. The whole point is to capture what's called the spread. That's the gap between what your investments are earning and what you're paying in interest to borrow. So, for example, if your portfolio is chugging along at, say, a 13% return, and you can borrow against it for just 4%, well, that 9% difference is pure rocket fuel for your financial engine.
So check this out. This is where it gets really interesting. When you actually run the numbers on this super aggressive strategy, well, a simulation starting with just a $34,000 portfolio shows a potential net equity growth of 171% in a single year. Yeah, a number like that definitely makes you lean in a little closer. But how on earth does that even work? So here's the math, at least on paper. Step 1, you invest your entire $8,000 monthly income, the whole thing. Step 2, you turn around and borrow $4,000 on margin to cover all your living expenses. Step 3, any dividends your portfolio kicks off goes straight to paying down that debt. And step 4, you just let your assets keep growing and compounding. Now, in a perfect world, where the market only goes up in a straight line, you can see how this creates this incredible, powerful loop that just builds on itself.
And that, of course, brings us to the big but, the catch. I mean, a 17% return sounds amazing, but this whole strategy is built on a mountain of leverage. And we all know leverage is a double-edged sword. When things are going great, it's absolutely fantastic, but when things go wrong, they go wrong really, really fast. Which leads to the most obvious question of all, right? If the math is this good, why aren't we all doing this? Why isn't this just the standard way to get rich? Well, the answer comes down to 3 huge risks that can turn this dream machine into an absolute financial nightmare.
Okay, risk number 1, and this is the big one, the margin call. See, when you borrow against your portfolio, your broker has a rule. They require your assets to be worth a certain amount compared to your loan. If the market takes a nosedive and your portfolio value drops below that line, the broker can and will force you to sell your assets to cover the loan. And they'll do it at the absolute worst possible time, right at the bottom of the market.
Next up is something called sequence of returns risk. The whole model we just saw assumes the market goes up nicely. But what if it drops 15% right after you start this plan? Now you're borrowing more money against a portfolio that's shrinking. You're basically pouring gasoline on the fire and amplifying your losses. It's the exact opposite of dollar cost averaging, and it can completely wipe you out if it happens early on. And finally, there's the toughest risk to manage, the one staring back at you in the mirror. Living your entire life on borrowed money, watching your debt climb while the market is swinging like a pendulum, that takes some serious nerves of steel. The psychological pressure is just immense, and it makes it so easy to panic and sell everything at the worst possible moment, locking in devastating losses. And look, this chart right here shows you just how fast the floor can drop out from under you. In our simulation, the portfolio grows to a healthy $137,000. Great. But a totally normal 25% market correction, something that happens all the time, would slash that value down to $103,000. With a $45,000 loan against it, your debt ratio skyrockets, and suddenly you're staring right over the edge of that margin call cliff. So, all of this brings us to a really fundamental choice. The problem isn't leverage itself. It's a tool like any other. The problem is how we choose to use it. And this isn't just a numbers decision, it's a philosophical one. It's about deciding what kind of financial institution you personally want to be.
So it really comes down to this. Are you going to operate like a big, high-risk commercial bank, using massive leverage, chasing every last dollar of profit, a model that is absolutely fantastic until suddenly it isn't? Or are you going to be more like a credit union, using leverage conservatively, focusing on sustainability, and making your number one priority not losing money? It's really the difference between trying to win a sprint versus finishing a marathon.
And this is where we make the pivot. We're going to take that exciting, aggressive idea and make it smart. This is the sustainable wealth blueprint. The goal here is simple. Capture most of the awesome upside of the original plan, but with a tiny fraction of the risk of blowing up your entire financial life. We're building a system that's still aggressive, but not reckless.
Okay, and you have to check out this table, because this is really the whole punchline. Just look at the bottom line, net worth after 1 year. It is almost identical between the two plans. But, and this is a huge but, the credit union model gets you to that same place with half the margin debt, with critical safety buffers built in, and with way, way less psychological stress. You get the same result, but you can actually sleep at night.
So how do we do it? We build a fortress. This means having layers of defense. First, a solid foundation of untouchable core investments in things like your 401k and IRA. Then, emergency cash reserves, so you are never, ever a forced seller. And finally, you have hard and fast rules, like circuit breakers, that automatically stop you from borrowing more when the market is falling. It's a system that's built to survive a storm, not just to look good on a sunny day.
All right, enough theory. We've gone from a wild idea to a solid, robust strategy. Now it's time to make this thing real. So here it is, the exact step-by-step plan to get your own sustainable wealth machine up and running in the next 7 days. Days 1 through 3 are all about building that fortress. First, you do a quick audit of your retirement accounts. Are you maxing out your 401k? Do you have a Roth IRA? Then you put all those contributions on autopilot. This becomes your untouchable core wealth. At the same time, you open a separate high-yield savings account and you fund your cash buffer. That's your sleep well at night money.
All right, now for the rest of the week, we're setting up the tools of the trade. You enable margin on your brokerage account, not to use it recklessly, but just to have it available as a strategic option. And you immediately set up those safety alerts at 25% utilization. Then, you build a super simple spreadsheet to track your progress. On day 7, you just review the checklist, make sure everything's done, and write down your starting net worth. That's it. That's day 0. You are officially launched. So when you boil it all down, this whole strategy is about one thing: consistency. It's built on a few really simple principles. Build your untouchable foundation first. Create safety buffers with cash and hard rules. And always, always pick sustainability over speed. This is a system that wins by not losing. The goal isn't one spectacular year. It's to have a system that reliably compounds wealth for decades, no matter what storms come along the way.
So let me leave you with this one last thought. It's so easy for us to get obsessed with squeezing out every last percentage point of return. But the real question, the one that actually matters, is how to build a financial system that you can emotionally stick with for the next 30 years. Because a brilliant plan that you abandon in a panic is completely worthless. So ask yourself, what system is not only going to grow your money, but is also going to let you sleep soundly at night? That's the only question worth answering.